afternoon, everybody. Good afternoon, Bill. Glad you're joining me today. I don't know about the rest of these folks. There we go. All right. Glad a few of you guys are sticking around for today's afternoon meeting. I am an associate member of T3 Trading Group, which is an SEC registered broker-dealer and member of FINRECIPIC. All of my trades are placed through T3 Trading Group. You should carefully consider whether trading is suitable for you in light of your own financial condition. Today is Tuesday, May 21st. My position disclosure is roughly the same, but I got stopped out of my Jumai equity. I still have these lotto calls, but they're not looking too hot unless me mania wakes up pretty soon. So yeah, everything else should be the same. So jumping in here, how did the market close? Market is green again. SPYs are up 0.2% or so. The Qs are up 0.2% or so, and the IWM is red by a pretty small amount. The market continues to stay bullish. So the intraday price action, still nothing too exciting here. We had a little bit of a gap down. We traded kind of strong throughout the day, and we closed well. I think the close is notable. And the market at this point is building out a perfect bull flag. This is a bull flag. A bull flag is a correction of extension through time. It is a trend continuation pattern. Basically what happens is when you are in a trend, that trend, a trend is a pattern of higher highs and higher lows, right? We all know that. But the way that those lows come in can be either through time corrections or through price corrections, meaning your market or your stock, it moves up higher, it hits a pinnacle in an expansion period. Usually you have some degree of extension at that short-term top. Because of that extension, the buyers take a half step back. Maybe there's some overhead supply from profit takers, and you'll get a market that will then either move sideways, it's a time correction, or pull back. A time correction is generally going to be more bullish than a price correction, and a time correction within a trend represents itself as a bull flag. That's literally what a bull flag is. It's just a time correction within the confines of an uptrend. And that's what we have here. This market is trending higher, broke higher. We know the importance of this day back here on May 6th. We extended on May 15th into the beginning of May 16th. And pretty much since the 16th, we've now had 4 trading sessions where this market has pretty much just gone sideways. And that's been great because look at how it has enabled this ADMA to catch up. And again, I consider the space broadly between the 8 and 21 EMA to be the technical equilibrium for any stock or market that I'm looking at. So when a market is trading above its 8 EMA, it's extended, and then you can have degrees of extension. And probably the best way to measure that would really be through percentages. It's this percentage extended from your ADMA, and then you could break that into price points. It's not going to be the same for each stock as it is going to be for the market. But broadly speaking, and maybe I should start to clarify this in terms of percentages as this market becomes more expensive, because the rules will change a little bit if you're just using price. But broadly speaking, in the last couple of years here, when we've gotten to more than $10 extended away from the ADMA, that has really been a point of more extreme extension where it's made sense to expect a correction through time or a correction through price. And what we've had here is a pretty much perfect time correction, which has now lasted for 4 trading sessions. And if you go back to, I don't know, highs here on the 15th, the market was trading at 530 with the ADMA just about at 520. So you had $9.50, $10 worth of extension. Fast forward to today, we're now trading slightly above that 530 price. We're at 531.50 at highs today, with the ADMA now all the way up at 426.63. So the ADMA, this upper band of our equilibrium zone, through this time correction, has moved up from that extension day here. It's moved up about $6, and yet the price action has only moved up about $1. So that is a way that you can represent that time correction, that the market has gone sideways. And again, that's great. It's very bullish. Basically what happens here is, as this market gets extended, you run into some overhead supply. And even think about us conceptually, right? And obviously, we're professional traders. So I like to think that we're pretty smart most of the time. So when we had hit this date here on the 16th at highs, we were the overhead supply. We were saying that morning, hey guys, we're really extended here. Let's stay bullish because the market's bullish. But this is a great opportunity into this extension to sell some of your longs, to book some profit, and potentially to put some shorts on. And I remember on that day, I was shorting TQQQ, booking profit on some long positions that I'm in. So think about that. If that's what's happening, market-wide, obviously we're a very small part of the overall market. That is literally what overhead supply is. But now fast forward here 4 days, and as this ADMA caught up, we are now going to be, as a group, and this kind of, I think, helps represent the market, we are going to be less inclined to sell in the same way that we were back just a few days ago, because we don't have that same degree of extension anymore, and potentially more inclined to buy for bull flag continuation. Well, that's exactly what the market is, right? We are the market to some degree. So you ran into this area of overhead supply. You go sideways for 4 days. What does that mean? It means bulls are constantly present. Bulls are creating demand here, and that could be represented just in people like us buying. That could be represented in the positive gamma that's in the market, that's kind of keeping an underlying bid on any pullbacks. That could be represented in the CTAs, if they're buyers in a flat to an up tape, which most of the time they are. That underlying demand stayed present, but you ran into an area where there was more overhead supply. That overhead supply is slowly eating away here over the course of 4 days of sideways price action. At the same time, because of that same situation, bulls are becoming more inclined to pay up in price, and that's what can lead to a breakout. That's literally just me breaking down into a supply and demand structure what a bull flag chart pattern actually is. And typically, we see that bull flags will continue on whatever time frame that you're looking at when the ADMA catches up to the base of the flag. So the lowest point of our flag here is 527.30. Our ADMA at the end of the day here is 526.60. So we're just about there. There's a good chance tomorrow morning, because that ADMA will move a little bit higher, there's a good chance that by tomorrow morning, the ADMA will be at the base of the flag. So that's why I said in the morning meeting today, every day that we're moving sideways up here, there becomes a higher probability that we actually get bullish continuation. And today was a strong day. I know it's a very low volume day. We can talk about that in a second. But overall, it's a strong day. We gapped down, yet we closed on highs. The ADMA should be caught up to the base tomorrow, and we'll see if we can get continuation. The number one way, from my experience, in which you can ruin a beautiful technical pattern like this beautiful bull flag that the market's building out is through some sort of fundamental event that causes a major change in those market technicals. We also potentially have that fundamental event tomorrow, right at the same time as this ADMA is finally catching up to potentially give us continuation. So if we didn't have Fed minutes tomorrow, and Fed minutes don't matter that much, but even especially if we didn't have NVIDIA tomorrow morning might be a day, depending on how we gap, where I say, all right, we can put our foot back on the gas pedal a little bit as far as buying goes, as far as new longs go. We were super patient for 4 days. The last 4 days have been boring for us from a market perspective. They've been boring for me in the morning meeting having to tell everybody, all right, be patient. We have a moderate degree of extension. Let's see how the market handles the extension. But finally, by tomorrow, we shouldn't have really any of that extension anymore as the ADMA is catching up. But we've got a major event after the close tomorrow that has the potential to totally ruin that party, which will probably mean that even though the market technicals are finally setting up pretty perfectly for continuation, we should still be a little bit cautious just in case that more fundamental event, which I'm talking about, NVIDIA earnings, which has become the most important earnings report of earnings season, and in some ways basically shuts down earnings season. This whole week gets a little bit slow, but we're anticipating NVIDIA. There hasn't been, really too much else that's been pretty major that's been reporting this week. A few names will still, even trickle out next week. Even a couple of names that I've got positions in report next week. I think the symbol S reports next week. I think Chewy reports next week. So there'll still be a couple of stocks that come out. But, we'll see what NVIDIA does, because this market is starting to look really ripe for continuation, finally, after 4 days of us being patient throughout this rest period. I want to get my foot back on the gas pedal and push the longs a little bit to see if we can get trend continuation or market continuation. But I've also got to recognize that there is a chance, because earnings reports are always a gamble. There's a chance that NVIDIA could aid this, and that NVIDIA shoots up on some incredible report and it's over $1,000, and the whole market, the spies and the Qs are being supported with a bull flag break. There's also a chance that the NVIDIA report, which is so anticipated, and I think that some of that anticipation is already in the stock price, disappoints, and the stock is back down in the 800s. I actually feel like, even though anything could happen, that the risk is a little bit to the downside on this NVIDIA report. What we have seen very much in this earnings season is companies that have had really good runs into their reports have to report some serious beats in order to actually continue higher. So my concern is that an inline report on NVIDIA tomorrow is actually something that gets sold. So it's interesting because on the one hand, the market technicals, which we're talking about here, are starting to tell me, hey, let's go. But NVIDIA, for me, is a cause for concern, because I do feel like the risk is to the downside on NVIDIA, even though it could certainly go up. And if that were to happen, it could cause the market bull flag to fail, just because of how important NVIDIA has actually become. Honestly, what I would love for anything else, more than anything else, is, and I don't always get what I want, is for NVIDIA's report to be just enough of a beat that the stock doesn't go anywhere. It gives a whole lot of volatility, and then by Friday morning the stock is still trading somewhere between $925 and $975. I would love that. I would love for the market to for NVIDIA just to kind of stay in range, to enable the market itself to kind of just do its thing, technically based, and shrug off the NVIDIA report a little bit. But we'll see how that goes. I've got no way of knowing, obviously, how that will go. But this market looks great. That's the SPYs. The SPYs look fantastic. That ADMA caught up. The Qs have some relative strength, but this ADMA has now already caught up to the 517 low. So the Qs look great for extension, for continuation, but because of the relative strength, there's a little bit more extension here with the Qs and with the SPYs. So as of today's close, we are $5 to $6 extended. Again, that ADMA will catch up a little bit tomorrow morning, and we can assess it then. And the IWM also looks good. Certainly the Russell has shown us some relative weakness these last few trading sessions compared to the SPYs or Qs within this consolidation. Some of that seemed like it was kind of based on interest rates, but the TLT was higher today, so that should have been a little bit more supportive. But the Russell, the ADMA is fully caught up as well, and we want to see if this IWM can push through this 210 to 212 year highs to start really giving us continuation. But again, overall the market's looking fantastic as long as we don't get a fundamental event like the Fed minutes, which I think the Fed minutes will just give us some volatility tomorrow, but won't really give us a directional move. But we should expect volatility on it. and then the more potential party ruiner or opposite, the life of the party is going to be Nvidia tomorrow. But the market looks great for continuation. I'm still really bulled up. I've been bulled up ever since we had the spies get back above 515. That was a big signal for us. I think back here on May 6th. Got a little bit ahead of ourselves from an extension perspective, but all that's turned into is a bull flag. And again, bull flags are even more technically bullish than price corrections. And originally I was kind of looking for more of a price correction, meaning us to trade down into the equilibrium area and create a pivot low and then work our way up. We didn't do that. We just went sideways up here and created this bull flag. So market looks fantastic, and we'll see what it can do. So that's from the market perspective. From an individual trading perspective, there's been a few decent trades every day within this consolidation, but as far as individual stocks, but you've really had to pick your spots. I don't think that it's been an easy few trading sessions within this consolidation, but that's why to take a half step back and also to dive in a little bit more on a topic that we were discussing yesterday. I really think that one of the keys to successful trading is knowing when to be aggressive and when to be passive on your trading, when to put on more risk because the stars are aligning and to trade more and to do more volume, and when to take a step back because you don't have that same degree of an advantage. And these last few trading sessions I think have been tricky from an index perspective and even from an individual stock perspective, but we've been able to recognize that in the morning meeting every day and say, okay, let's not be pedal to the metal. I keep going back to that analogy for whatever reason. Let's, really pick our spots and be selective and, use a percentage of our normal risk until the market sets up a little bit better. Finally, we're at that time where the market is setting up a little bit better. So, as far as trades today, I tried that pay O someone brought up in the morning meeting. I really liked the idea of this thing and the opening candle on this. Oh, wow, this thing actually closed well. It's frustrating. The opening candle was great, and then the thing just, look at the opening volume on this first bar for the breakout through $5.90, and then the volume just died, and the stock did absolutely nothing. So I ended up getting stopped out of this thing. I took a little bit of a loss on it, not too bad, but took a little bit of a loss on it. And I was saying it at the time, this is why execution is so important. Execution is most important in trades that don't work. Having good execution, I think, is really most important when trades don't work. Sure, if you have bad execution, you get a bad price, and your trade works, you're probably going to make a little bit less than you would otherwise. But you bought the stock's going up, that's not that hard, you're going to make money no matter what. What really matters is when your execution's not as good and the trade fails, because a lot of times good execution is the difference between potentially getting your risk covered or not. So really, the proper entry price that we had discussed on this thing was to buy $5.90. I missed it. I was late. I typed up a little bit late, but I saw the great volume, and the inside offer was 94. So I said, the volume's great. I don't mind paying up an extra 4 cents because the volume looks so good. So I ended up buying $5.94 instead of the better execution would have been $5.90. And it's even with the good execution, honestly, it's close. And if you could have gotten your risk covered on it, maybe. But with the not perfect execution, there was no way for me to get my risk covered. I ended up buying $5.94. Stop loss was the low of the day, $5.86. So I've got 8 cents of risk there. So I'm offered 10 cents in the money to get my risk covered. So I got an offer at $6.04 to get my risk covered. The high is 6. And then I get stopped out, and I never was able to get that one-to-one kick to cover any risk. Had I purchased the right price that I got in $5.90, maybe, just maybe, I would have been selling, first of all, I would have had slightly less risk. I would have been risking 4 cents instead of risking 8 cents. So I either could have had less dollar risk for the same tier size or taken more tier size for the same dollar risk. That's usually my preference. And maybe, it's hard to say, I could have gotten a fill at $6, which happens to be the high, or maybe I even would have been at $5.99 because I usually don't like to sit at whole numbers. maybe I would have gotten that fill to get my risk covered, and then when the trade actually fails, my P&L at the end of the day is a 0 instead of a negative number. So it just kind of shows the importance of execution. And I chase sometimes a little bit because sometimes you have to. You can't always have perfect execution because there's so many things that you're watching at once, and it just kind of is what it is. And if I'm not chasing by too much and I feel like I've got good layers of probability, like good volume confirmation like this, then I'm willing to do it. And that's kind of what I did in this situation, and the trade just didn't work out. The flip side was this JOBY. I was able to have some better execution on this thing below $5 when there was a headline on it this morning. It was breaking up. It didn't really give me the volume confirmation in the same way that I would have liked. Definitely not an A+ trade by any means, but off that headline, I thought if it could really clear through and get back above this $5, that maybe this thing starts to break out through here. Especially we're in a market environment right now where we're seeing so many short squeezes going off all across the board that I'm still inclined to be a little bit more aggressive on these crappy names to see if, hey, maybe I capture the one where I'm buying it through 5 and they squeeze it up to 9 just because of the short flow and bullish option flow comes in and there's news or whatever. So this one, a little bit better execution, also worked better. Was able to get enough of a move to get risk covered before it stopped me out, even a little bit more than my risk covered. So even though this was also a failed trade, I was actually able to be a little bit positive on a failed trade. And that's good game planning, Good game planning and good execution is definitely the difference between you just taking outright losers on trades that fail versus you being break even, or in the case of this JOBY, actually even being able to make a little bit of money on a trade that doesn't work out. So that one was pretty decent. I had a good call on Jumai at this low. The execution was difficult because they upticked it so fast, but I was able to get some stock in there. But then it gave 0 follow through, and I had to just close out of my position and into the close just because it's below where my big picture stop loss is supposed to be on my game plan for the trade. So good day trade in Jumai that helped, but failed swing trade on it, and I stopped myself out and I liquidated that position. Another good call on Peloton at this low on the way up here at 10.35. A decent call, I should say. It's not like it was a bottom that brought this thing back up to $4, but a little bit of volume come in, it got a little bit extended, it kind of created a potential double bottom here with the break of this previous low, and then some bullish option flow came in for like 350 and 4, I think, at the same time. So that was an okay trade. I think Cody and myself were able to sell a little bit of stock at 12.30 at like $3.41, and then this one also then didn't give any follow through, so made it really difficult to swing anything. GameStop was a bit of a struggle today. GameStop giving an inside day today, so we'll keep an eye on it tomorrow. But there was a heavy seller just dumping into that 22 and above 22 pretty much all day. And occasionally he would let up, or she would let up, and you would get this quick uptick through 22, and then they would jam it all the way down. Anybody that bought that stock was, kind of in trouble. That's exactly what you saw here at 350 when this thing then tried to break out through that 22.30 area again. Seller came right back in, jammed it. You get this big puking of stock of all the people that bought in this area. And the interesting thing about it, though, was every time they did try to jam this down, it got bought back up. So I've definitely seen in this GameStop, because I've traded it every day recently, that there's been really good demand in this $20 zone. The stock has had ample opportunity to fail down further and really get back down to the teens and close beneath 20, and hasn't done it. So there is still an underlying demand in GameStop. The problem is, the flip side of that underlying demand is that there has been some real supply that I think is still stemming from the move into the 40s, combined with this secondary offering that got announced on the 17th, which caused the stock to have this huge gap down and then just trapped a whole bunch of people who probably bought in this area who are selling into these upticks right now because they're just kind of trapped. So we'll see with GameStop if this underlying demand that's been holding this thing above 20 can eventually clear out the supply of these stuck folks up here to break this thing back up, or if the opposite occurs. There's a battle going on right now between buyers and sellers, and it's very difficult to say who will win. But I really like the fact that they keep buying this thing kind of right back up into that supply zone. So that tells me that in time, as we deteriorate that supply, maybe this GameStop can break up. And I've been saying it every day. Maybe I could be wrong, but I really don't think that the meme mania that happened on Monday a week ago, which then took a back seat Monday this week, specifically because of GameStop secondary, I really don't think that the trade's totally over yet. I will admit that idea is wrong if I see this thing close beneath the $18 to $20 area. If I get a close, on lows in the $18 area in GameStop, then I'll probably have to, kind of admit defeat and say, hey, it was fun that we got a meme craze back for a week. It created some really good trading opportunity, but the fundamentals are taking over, and the stock is done, and all these other names are done. It's just done until it comes back again, because it does seem like it may happen again in the future. I did think that it was really interesting from Pat's note this morning, which I mentioned in the morning meeting, but I'll mention it again now. Just this paragraph in here. Fundamental hedge funds survived the Roaring Kitty meme scare and managed to add 52 basis points to year-to-date performance last week. So fundamental hedge funds are going to be companies that view GameStop at $45 as overvalued and therefore would want to be short. So not only did they not get squeezed out and take a big loss, sorry RFK, but they actually were able to make money as a result of these stocks going to even more unreasonable prices, but them not getting squeezed out and being able to probably add to those shorts and make money off of it. Pat, what's the source of this one? Is this a Goldman note? I just want to make sure I source it properly when I talk about it. If you're listening, I know that this is Bank of America up here. This is Goldman. Yeah, this is Goldman in here. So credit to Goldman Sachs for providing that data. So that is pretty much all that I think I've got for today. Let's see if we can get continuation tomorrow. This market looks ripe for it, but we'll see what happens with NVIDIA. I mean, that's going to be the big thing right now. I guess I'll mention real quick also just the volume thing, which is interesting. Bill K here gave us a quote from SM, whoever that is, that the SPY traded only 22.5 million shares on the day by the close. That's less volume than during the half day on November 24th, Thanksgiving. And unless I'm mistaken, the lowest volume ever for the SPY on a full day of trading. I'm sure it's not ever, because at one point this was a brand new ETF. But yeah, you can go back, I think, to 2002 and find some lower volume days. But yeah, really low volume. Which, we talked about this a little bit in the past, and I see Rock here mentioned that you want the market to be making all-time highs on high volume. I don't necessarily think that you need volume for continuation of these types of trends, especially when we are in a consolidation period. I do want to see if we get like a big break higher of this bull flag. I do want to see an increase in volume compared to today's anemic volume for sure on that. But I don't necessarily. I remember I mentioned it the other day. I remember trading in 2013, and the big complaint from the bears in 2013 was a year that the S&P was up like 33% on the year. The big complaint for bears the whole year was there's no volume confirmation. There's no volume confirmation. The move can't be real, and yet we were able to just kind of climb and grind higher on no volume throughout the year. You can move higher and have it be okay on no volume as long as there's no sellers. If the sellers come in and the buyers aren't there, then it's a problem. Bill giving us the link to what I just read. That's from Sven Heinrich. at the Northman Trader on YouTube. Sorry, on Twitter. Sven Heinrich. It's a really cool name. Cool. So that's all I got. I'm happy to answer any questions anybody has. Not seeing anything in the VTF for now, so feel free to post questions in there. Over on the YouTube from Gabriel, on a gap down on the NVIDIA report, do you think it'll be a good opportunity to get some stock at lower prices? I'm not sure if you mean, when you say get some stock, if you mean the market itself or NVIDIA. Expectations are too high on the report, but chips demand will still be high. It's really hard to say at this point. We need to see, just how big the sell-off is and the specifics of the report, I think, to get an idea. If the report's not a disaster and the stock trades down enough being a very subjective word, I do think it would be a buying opportunity, but it's hard to say exactly where at this point, and we definitely need to see the numbers just to get an idea of, just like what I'm talking about, where I think the risk is to the downside. So is this a situation where the numbers beat across the board? They're pretty good, but they beat by a little bit, so they're setting the stock down 12%. Yeah, maybe that's a buying opportunity. And yeah, maybe it creates buying opportunities a little bit in some of these other chip names. But the other chip names are also a little bit more expensive right now. I like Micron a lot. I like that Micron 130 a lot. I like the idea of big picture buying dips in this thing. But we'll see. We'll take it as it comes. AMD is still a little bit trickier. I've got a position in it. If AMD is down on the NVIDIA report, but still above my stop out price, which I think is like a 154-ish. It's basically the low of this day. Yeah, 154.70. If AMD is down on the NVIDIA report, but still above my stop loss, then yeah, I'm probably going to add in front of that stop. But we'll see. We'll see how it plays out. And if AMD loses that like 154 to 155 area, then the chart's going to look nasty again, so I probably wouldn't want to actually buy it below that price. But we'll see. AMD got real beat up from that high, which that high was ridiculous. Getting up to 227.30 on that day. But it moved back from 227.30 to 140-ish. That's a $90-$100 pullback on the stock. That's a really healthy correction in this thing. But the flip side, like we've discussed, is that is also represents a lot of relative weakness there. What else, guys? Anything else, guys and gals? Nothing? Quick one today? Yeah, I know. Not too much to talk about just with how the market's been trading. But we'll see. We might have a little more to talk about tomorrow. I got a feeling we will. So we'll leave it at that. Have a great night, everybody. I'll see you all tomorrow.